Street. Mama nizo.
Department. And this corner and now check up and continue so my final so many. Also. And what about that? Is it? Right, good afternoon, class. Anyone hearing? Right, Meta, could you indicate your presence? Could you indicate your presence, right, Meta? Afternoon, Trish, can you hear me, Trish? Good afternoon, class.
Yes, sir, we can hear you. How are you?
Fine, and you? How about Trish? Can you hear me? Ah, that's great. That's great. So this marks our second lecture. Our second lecture today. Thank you very much for attending this lecture. As I highlighted earlier on, our course structure, it is the introduction to cost and management accounting. Management accounting in contrast to financial accounting. Role of management accountants in an organization. Cost behavior, fixed and variable costs. They are used in predicting costs. Cost of goods manufactured schedule. cost of goods sold and contribution income statement, valuation of inventory and fixed assets, methods, job order costing, budgets and budgetary process, setting direct material and direct labor standards, computation of direct materials and direct labor variances, their significance, and lastly, the computation of target selling prices and the interpretation of financial statements. So in the last lecture, we had learned the introduction part, the duties of the cost and management accountant, his roles, and all the stuff. So today we are going to look at the costs, a new chapter. We are going to look at the new chapter today, which is cost behavior. Cost behavior. So we are going to touch on fixed and variable costs, their use in predicting costs. We are looking at fixed costs, variable costs, and then cost volume profit analysis, and see how the cost volume profit analysis is used in the business, and then be in a position to look at its limitations and the methods of how you can be in a position to come up with the break-even formula if you are using the cost volume profit analysis. And then how to calculate the margin of safety. That's what we are going to learn today. And I will be in a position to, are you seeing the slides? Are they legible? The slides, are they legible? That's great, Tricia. I can see your comments. How about the other guys? How about the other guys? Can you see the slides, all of you? Yes, I can see Nyasha, I can see Trish, I can see Pride. Trish has sent her comments already. How about the Pride and the Nyasha? Pride and Nyasha, can I have your comments regarding the slides? You can either type on chat or you can be in a position to use the microphone. That's great, Nyasha. I can see your comments. I can see your comment, Nyasha. How about Pride? Can I have your comment, Pride? That's fine. So we can get along when Pride is comfortable. That's when we are good to go now. We are good to go. So on cost behavior, if we look on the fixed costs, you can actually see that the fixed costs are costs that do not change as activity levels increase. Fixed costs do not have a driver. So in this case, if we are saying fixed costs do not change as the level of activity increases, I can give you an instance of the monthly rental. You might be renting a building where your factory is located. Each and every month, you might be paying 12,000 per month. But if you are producing 100 desks, you can see that despite the fact that you have produced the 100 desks, you still have to pay $12,000. But in this case, if you produce 5 desks as well, you are going to still pay the rent of 12,000. That's the reason why. That's why we are saying the fixed costs are not costs that do not change with the level of activity, despite the fact that you would have. Despite the fact that you would have, is there any connection? Is there any connection? Can you get me? Hello? Can you hear me? Sorry, there was an interruption. There was an interruption of internet. Could you be in a position to indicate whether I'm now connected? Hello? That's fine. That's fine. So we can proceed now. So basically what I've been saying, the fixed costs, they do not change in line with the level of activity. Basically what I'm saying, even if you produce 100 desks, you will be in a position to pay the rental of 12,000. But if you produce 5 desks as well, you will be in a position to pay the same rental of 12,000. So that's why I'm saying the fixed costs do not change in line with the level of activity. And then when we are saying the fixed costs do not have a driver is something that pushes a cost. So I will explain later what a driver is, and then we need to switch on to variable costs. Variable costs are costs that increase incrementally with a driver as the driver increases. For instance, if there is labor, a direct labor, you can actually see that if our cost driver is hours, when you spend more hours in the work, you can be in a position to have much cost than when you are working a few hours. So you can actually see that the driver will be the hours. And then if you work more hours in that, you can be in a position to see that eventually the cost will increase as opposed to the period when you will be not having many hours. So that's the significance of variable costs. So the two of the most common drivers used in managerial accounting are units and hours. But there are lots of different drivers that could be used like customers or miles. So you can see now the difference between fixed costs and variable costs. We are saying the fixed costs do not vary in line with the level of activity, but the variable costs, they vary in line with the level of activity. So that's the difference between fixed costs and the variable costs when we are looking at the cost behavior. Am I clear on that? Am I clear on that? Am I clear on that? Nyasha, could you be in a position to just state what I've just been highlighting. Nyasha, could you be in a position to state what I've been highlighting, the difference between fixed cost and the variable cost? Am I loud and clear? Who can give it a try? Who can give it a try, right? Can you give it a try? The difference between fixed cost and the variable cost is I've been illustrating. I can't get pride. Trish, can you give it a try?
Hello, sir.
Yes, Trish, can you give it a try?
Yes. So you were saying that fixed costs are costs that do not change as the level of activity changes, whereas variable costs will change with the level of activity. And you gave an example of rent for fixed costs, where you were saying that if you're producing, say, 50 chairs, and then your production increases to maybe 100, that has no effect on the rent, on the monthly rent you'll be paying. But when it comes to variable costs for things like, you gave an example of overheads.
Yes.
And you're saying that as the production increases, so does your overheads. That's what
that's
I've
great,
got.
Trish. Thank you very much, Trish. So we have, all of us, we have comprehended the difference between fixed costs and the variable costs. So those are the costs that will then be taken into account by the management. They would need to see if we can be in a position to increase this level of production, which costs can we be in a position to incur, be it variable costs or fixed costs. Management is interested in those costs in order to be in a position to come up with the total costs. So if you can be in a position to see now, when we are going to look on the cost volume profit analysis, that is going to be shown graphically what will be the behavior of cost now, be it the fixed cost or the variable cost. You are going to see that the fixed costs, they are going to be shown graphically. They will be that line will be running parallel with the x-axis, and the variable cost, they will start just right from the fixed cost when they would have started going upwards. So you need to reckon that the fixed costs, they do not change with the volume they do not change with the level of activity. So that's the reason why they are running parallel with the x-axis. But if you look on the variable costs, they will then start from the point where the fixed costs would have started going upwards. So if we can be in a position to compute the fixed costs and the variable costs, that's when we can be in a position to start have the total costs. But then when you get the total cost now, you then need to see what your revenue is now. Your revenue line now, it starts from the 0 point going upwards. So you can actually see now that when you plot your fixed cost line and the variable cost line, you now have your total cost and your total revenue on the line, the total revenue line. So if you can say the total revenue minus the fixed cost plus the variable cost, that's when you can be in a position to get the profit. But then the management, it is that profit volume analysis. The essence of that profit volume analysis, the management will want to see at which level can we be in a position to break even. At which level can we be in a position to have so many profits? At which level are we going to have losses? So management is interested in that profit volume analysis, that they can be in a position to see the impact of different levels. So profit volume profit analysis looks at the impact of the operating profit due to the varying levels of volume and the cost, and determine the break-even point for cost structures with different sales volumes that will help managers in making economic decisions for short term. So you can actually see that the management is interested in the behavior of fixed costs or variable costs in order to be in a position to determine their profits, in order to be in a position to determine where they are breaking even. So you can actually see that the break-even point, that is the point where there are no profits, where there are no losses. That's the point management is interested in. So we need to reckon that break-even point. So we also need to see how we calculate the break-even point. So that's the essence of the cost volume profit analysis. We are on point 3.3. Are we together on point 3.3? On point 3.3, are we together? So it goes on to illustrate that the cost volume profit analysis includes the analysis of sales price, fixed costs, variable costs, number of goods sold, how it affects the profits of the business. So the management is interested in the impact of these cost behavior, being the fixed cost and the variable costs, and how they are going to affect the profits of the business. And then the other aspect, the aim of the company is to earn profit. The profit depends upon a large number of factors, most notable among cost of manufacturing and volume of sales. These factors are largely interdependent. So you can actually see that a profit is largely dependent on the volume of sales, as I highlighted earlier on, that if you can be in a position to have fixed costs and variable costs, if you subtract it from the revenue, that's when you can be in a position to determine your profits. So you can actually see that those profits are anchored on the volume of sales or the cost of manufacturing. If you can be in a position to manufacture having the lower costs and be in a position to have a higher volume, you can be in a position to realize much profit. And then bullet point, another bullet point, the volume of sales is dependent upon production volume, which in turn is related to costs that are affected by the production or production mix, internal efficiency of the business, production methods used. The cost volume profit analysis as well, it helps management in finding out the relationship between cost and revenue to generate profit. So that's the essence of the profit volume analysis to management. The cost volume profit analysis as well, analysis helps them to calculate the break-even formula for different sales volume and cost structures. So you can actually see that the cost volume profit analysis, it would be in a position to calculate the break-even formula. And with the CV analysis information, the management can better understand the overall performance and determine what units it should sell to break even or reach a certain level of profit. So as I highlighted earlier on, if you have got the variable cost, you can see that you might be in a position to have different variable costs on different levels of production, but that doesn't affect your fixed costs. So the management will then need to see at which level can we be in a position to have a break-even point, whether on the level where we are not going to make a profit, where we are not going to make a loss. the break-even point, it has got the impact, or it has got the importance of highlighting to the management that in the near future, if we can be in a position to continue having this business, we might be in a position to have some profits in the near future, or we can be in a position to make a decision to shut down. Because if you are operating below the break-even point, you might be in a position to come up with a decision to shut down. So it is up to the cost and management accountant now when analyzing the profit volume analysis of the company, you then be in a position to highlight to the managers whether you are going to, we can be in a position to run this company as a going concern, or we can be in a position to make a decision to shut down, being highlighted by the behavior of this, being highlighted by the pictorial behavior of the cost volume profit analysis. So that's the main essence of profit volume analysis. Is there anyone with a question on that so that I can get, you can get clarity? Is there anyone with a question so that you can get clarity? Thank you very much. I can see some other students coming in. I can see Zimdat Post Solution. I can see another student who just joined us. Thank you very much. Is there anyone who have got a questions before we proceed? Okay. Having comprehended the cost volume profit analysis, we then need to see how we can be in a position to calculate break-even point. How we can be in a position to calculate the break-even point. So in order to calculate the break-even point, we then need to see, we simply mean, when we are saying break-even point, we are referring to the covering of all costs without making a profit. The break-even point is when total revenues and total costs are equal and there are no profit but also no loss made. So that's the essence of the break-even point. You are looking at the point where you are not making losses, where you are not making profits. So the method of calculating break-even point, we then need to see that how many methods we might be having to calculate break-even point. The first method we will need to look at is the equation method, which says total revenue minus total variable costs minus fixed costs equals to profit. So that's the first method, the equation method. Total revenue minus total variable costs minus total fixed costs, that will give us the profit. So if you can actually see that when total variable costs and total fixed costs are equaling our revenue, we are not realizing profit at all. But if you can actually see that the profit, the variable costs and the total fixed costs are lower than the revenue, that's when we can be in a position to realize profit. So the total fixed costs are used rather than unit fixed costs, since unit fixed costs will vary depending on the level of output. So you see the selling price and the costs are assumed to remain constant per unit of output. So another method which we might be in a position to calculate the break-even point, that's the contribution margin method. The contribution margin method entails us to get the contribution per unit and the selling price per unit less the variable. The contribution per unit, it is the selling price per unit less the variable cost per unit. That's how you can be in a position to arrive at the contribution per unit. So when you get this contribution per unit now, you then need to figure out how much are your fixed costs. So in order to get the break-even point in line with this method now, you then need to say fixed cost divided by contribution per unit. That's when you can be in a position to have your break-even point in units in line with the contribution margin method. Are we together on this? We have covered the equation method, we have covered the contribution method, the margin method. Is there anyone with a question before we move on to the graphical method, where you are going to see pictorially now what transpire, what the lines of revenue, the lines of variable cost, the lines of fixed cost would then look like on the graph. Is there anyone with a question on contribution margin method and the equation method? Could you be in a position to highlight to me? Is there anyone with a question on that before we proceed? If you are in agreement, could you be in a position to show by raising your hands, or you can be in a position to unmute and then give it a comment? Anyone who can be in a position to give a contribution, or who has got a question before we proceed to the graphical method? Is there anyone? Hello? Chichirimo ere classic allowed that is Simon. Yes, I can get the charts. Thank you, Trish. You are indicating that you have understood. So can we be in a position to proceed now? Okay, we can go on to the graphical method now in line with the cost behavior. The graphical method. So with the graphical method, the total cost and the total revenue lines are plotted on a graph as shown on the y-axis, and units are shown on the x-axis. So you can be in a position to see on the graph now. The graphical method has been shown. If we can go on to bullet 3.3.1, that's where we can see the break-even point, how you can be in a position to illustrate the break-even point. So you can actually see that the fixed cost line, can you see that it is running parallel with the x-axis, and the variable cost, it is starting from where the fixed cost starts and going upwards. That's our variable cost. So our revenue line now, it starts from the 0 point going upwards. So you can actually see that if you add on the fixed cost and the variable cost, that's when you can be in a position to get your total cost and your revenue. So the line where the total cost line or the total cost line intersects with the revenue line, that will be our break-even point. Can you see now the break-even point? Our break-even point, it is 100 units. Can you see it? It is 100 units. So you can actually see that if we produce units below the 100 units mark, we will then be in a position to realize some losses. For instance, in a factory, you are producing 80 units. Maybe your rentals are 12,000, as I highlighted earlier on, but you are producing 80 units and having the variable cost. You can actually see that your revenue cannot be in a position to cover the fixed cost and the variable cost, which would have been incurred in that unit of production. So you can be in a position to realize some losses now. So from the 100 units mark going below, you can actually see that you are now making losses because your revenue cannot be in a position to cover the total fixed cost and the total variable cost that will be in a position to give you your total your total cost. But if you can be in a position to go above the 100 mark now, if you are producing 120 units, you can now see that you are making some profit because your fixed cost and your variable costs now are lower than your revenue. If you add up your fixed cost and the variable cost, you then be in a position to get your profit because your revenue is surpassing the fixed cost and the variable cost, which is your total cost. Can you now see now how we can be in a position to illustrate this graphically on the table? Have we understood, all of us, the three methods of how we can be in a position to calculate the break-even point, which is the equation method, the contribution method, and the graphical method? Can we be in a position to get those methods now? Anyone who can explain what we have just learned? Anyone who can explain what we have just learned? Anyone who can explain what we have just learned? Pride, can you give it a try? Pride, can you give it a try? Hello, Pride? Okay, Nyasha? That's fine, Nyasha. Basically, what we are saying, Nyasha, I can get your comment that I'm lost is on graphical method. Basically, what we are saying, Nyasha, here, when you are having your fixed cost, let's say 12,000, isn't it? And you are producing 80 units, you can actually see that your fixed costs, as we highlighted earlier on, that the fixed costs do not change in line with the level of activity. Understand? So that's the reason why you can see that the fixed cost is running parallel with the x-axis. Despite the fact that you have produced 80 units and you have come up with your variable costs, but then if you are having those now, the fixed cost and the variable cost at 80 units, you are not covering the total revenue that is being realized is not covering those costs. That's the reason why we are realizing some losses. But when you get to the point of the 100 units now, we are saying that the fixed costs and the variable cost, which you have realized the total cost, it is equaling with your revenue. That's why we are saying that's the break-even point mark. But when you produce 120 units, still you are getting the fixed cost at 12,000, but your actual revenue, it is now catering for the total cost that would have been realized. Your revenue is above the total cost that would have been realized. That's the reason why you are saying that on the above the 100 units mark, we are now realizing some profit. Did you get clarity on that? Nyasha, can I have your comment? Have you understood, Nyasha? That's great, Nyasha. I can see your comments. We are good to go. Anyone who have got some questions before we proceed on the cost volume profit analysis? On the cost volume profit analysis? Okay, Lennon. what we are saying, as we are saying that, so we are saying the more the revenue, the lesser the cost. Basically, we are saying when you produce, when you have got a higher level of the higher level of production, you can that level of production, you can see that because the fixed costs, they are not changing. The production now, it will then have an impact of having of covering the fixed costs and the variable costs. So that's the reason why you are making some profits. But then I'm agreeing with you that if you are saying that we are saying more revenue, the lesser the cost. The reason why we are saying that the costs are now lowering, you are having a higher level of production, isn't it? That we have a bearing now because your fixed costs are being incurred with a higher level of production. So that will then be in a position to cover your fixed costs and the variable costs. So that's the reason why we are saying if the revenue increases, not revenue per se, we are saying as the level of activity increases, not the revenue. Because the level of activities, we are referring to the units. Because when you say revenue now, you are just looking at the total amount which you have got. But to get the actual concept, you need to look at the level of activity. So we are saying that when you are having 120 units, that's when you can be in a position to realize your profit. So when you are saying revenue increases, the lesser cost, basically, I would love a scenario where you can be in a position to comprehend it in the sense of the level of activity, not revenue per se. Understood? Have I clarified your question, Lennon?
Yes, you managed to.
That's great, Lennon. So, is anyone who has got some gray areas on the three methods of calculating the break-even point? So, given a scenario that I have presented a question for the calculation of break-even point, be it the graphical method, be it the contribution margin method, or the equation method, can you be in a position to tackle that question? Hello, Lennon?
Can you come again? Say, I can't hear you clearly.
Okay. We are saying if we can be in a position to present a question on the three methods of calculating the break-even point, will you be in a position to tackle it in the graphical method, in the contribution margin method, and the equation method? Anyone who have got a challenge on those methods? You can show by raising your hand, or you can be in a position to show by unmuting and indicate. Nyasha, do you have any challenge on the methods? Or Bright, do you have any challenge on the methods? Thank you, Nyasha. I can get your comment. How about Bright? Are you comfortable now? Lennon, could you be in a position to mute your microphone? Can you be in a position to mute? Thank you very much. So we can then proceed now That's great, Pride. I can get your comment. You are now comfortable with that. So we can then proceed now with the cost behavior analysis. We can proceed now. We are now comfortable with the three methods of calculating the break-even point. That is the graphical method, the contribution income, and the equation method. That's great. I can get everyone is in picture now. So we then need to look on what, if we can go on to point 3.3.2, we then need to see what we refer to as the margin of safety. What is the margin of safety? You then need to tell the management what the margin of safety means. Because the essence of the cost and management accountant, you are the advisor to the management. The management is looking upon you whether they can be in a position to make sound decisions. So you are the advisor to management whether you are going to make sound decisions for the sustenance of the organization. So in interpreting your information, as I highlighted earlier on in the last lecture, that the essence of the cost and management accountant, you need to accumulate information, you need to interpret the information, and you need to be in a position to analyze that information, communicate it to management so that they can be in a position to make sound decisions. So that's the essence of the cost and management accountant. So in employing this tool now, the cost volume profit analysis, we are saying to management, given a level of production, we can be in a position to make losses. Given this level of production, we can be in a position to come up with our total cost, having reckoned the fixed costs and the variable costs. The reason why you can be in a position to highlight to the management the cost volume profit analysis graphically, there might be a change in the price in the market. You can be in a position to highlight to management that despite the fact that there is a change in the price of our product in the market, we can be in a position to still make some profits. So basically, you can be in a position to have a good market share despite the fact that you have lowered your prices. So that's an indicator to management that given a scenario that we have changed our prices, we still have to make some profits given the production at a certain production level. So the management is interested in those the various changes now in the level of production, the various changes in the prices, so that they can be in a position to assess whether they are still viable in the organization, in the marketplace. That's the essence of your explanation to the management, and be able to give sound decisions. So we can be in a position to proceed now to the margin of safety. So you can see that the margin of safety, it indicates how much sales can decrease before a loss occurs. That is, it is the excess of budgeted revenues over break-even volumes, break-even revenues. So you can actually see that the budgeted revenues which you have assessed when you draw your budget, but then if you can be in a position to less those revenues, to less the break-even revenues from the budgeted revenues, that's where your margin of safety is now. If we can be in a position to go on our graphical method, I can show you now where our margin of safety lies. You can see from 100 units to 200 units. If you subtract 200 units, if you subtract 100 units from 200 units, that's when you can be in a position to get your margin of safety. So the margin of safety is the tolerance units you can be in a position to realize before you make some losses. So basically, in order to get your margin of safety, you simply subtract revenue, budgeted revenue, minus the break-even revenue. That's when you can be in a position to get your margin of safety. Am I clear on that? Your comments, am I clear on that? The margin of safety? Are we on the right page? Are we on the same page? That's great. I can see your comment, Pride. You seem to comprehend. Any other guys? Can I have your comments? The other guys? I can only get Pride's comment. That's great, Trish. I can see your comment, Trish. You have just posted your comment. The other guys?
Can you try to come again on the formula margin of safety, if it is possible?
Okay. In order to get your margin of safety, you would have, isn't it that we have come up with our break-even point, isn't it? Our break-even point. So in order to come up with the margin of safety, you then say budgeted revenue minus the break-even point revenue. That's how we can be in a position to come up with the margin of safety. Basically, the margin of safety, we are saying this is the range at which we can be in a position to drop our revenues before we make some losses. That's the essence of the margin of safety. Am I clear on that? Am I clear? That's fine, Lennon. I can get you now. You have just posted your comment. Thank you. So are there no any gray areas before we proceed? Any gray areas which I might need to clarify before we proceed? Okay, fine. So we can now proceed now. We need to see the importance of the CV analysis now. What is the importance of the cost volume profit analysis? We can see that the CV analysis helps in determining the level at which all relevant cost is recovered and there is no profit or loss, which is also called the break-even point. We are on bullet 3.3.3. That's what I'm reading. Are we on the same page? On bullet 3.3.3, are we on the same page? Indicate by showing your hands, or you can indicate by posting. Bullet 3.3.3, the importance of CVP analysis. That's great. I can get your comments. Yes, Nyasha, I can get your comment. Thank you very much. So the importance of CV analysis, it is saying when it helps in determining the level at which all relevant cost is recovered. So basically what I've been saying, that is the, if we are saying the relevant costs are covered, we are referring to the variable costs and the fixed costs. Those that is being highlighted that the relevant costs are covered. So if you can be in a position to see a scenario where your revenue is surpassing the total cost, that's when you are realizing profits. But if your revenue is equaling to your total cost, you are not realizing any profit or loss. You are on break-even point. But when your revenue is not covering the total cost, you are realizing some losses. That is the one that is being illustrated by this statement. that the analysis helps in determining the level at which all relevant cost is recovered and there is no profit, which is also called the break-even point, as I highlighted earlier on. It is that point at which the volume of sales equal to the total expenses, fixed costs and variable costs. You can see that that's the reason why we are placing them in brackets, because the volume of sales equal to total expenses, that is the fixed cost and the variable cost. Thus, CV analysis helps decision makers understand the effect of a change in sales volume, price, and variable costs on the production of an entity, while taking fixed costs as unchangeable. So you can actually see that if you can be in a position to play with this now, the sales volume, the price, and the variable costs, you can have different profits, you can have losses, but you can actually see that your fixed costs, they remain the same. You see now the reason why we are saying the cost behavior, because if the volume behaves, price behaves, the variable cost behaves, you can be in a position to realize different profits. So the management would then need to see if we can be in a position to change the sales volume, if we can be in a position to change the price, if we can be in a position to change the variable cost, what will be the impact to our profits? Because the ultimate goal, the management is mainly concerned with the profits. That's the essence of running a business. You need to make some profits. So that's the reason why we are making an analysis of the cost volume profit analysis. The CV analysis helps in understanding the relationship between profits and costs on the other hand, and the volume on the other. The CV analysis is useful for setting up flexible budgets that indicates costs at various levels of activity. When you are going to deal with the budgets, the topic for budgets, you will then be in a position to see the impact of CV analysis now, because you will then be in a position to look at the behavior of variable costs at different levels of activity. So you can be in a position to see that they can be in a position to have an impact on the budgets. So we can be in a position to flex our budget now in line with what has been produced, the actual production. So the flexible budgets now can then be in a position to come into play when we would have analyzed the CV analysis. So that's the importance of the CV analysis as well. The CV analysis is also helpful when a business is trying to determine the level of sales to reach a targeted income. So you can actually see that the CV analysis helps again to determine the level of sales as well. Because at different levels of sales, you can be in a position to have different revenues. As illustrated on our graph, if you are looking at the production of 120 units, you can be in a position to realize revenue on that level. If you are going to produce 140 units, you can see that the total revenue which would have realized on 120 units as opposed to 140 units, they are different. You see now. Are we together on that? Are we together? Are we together? Are we together? That's great. I can see your comments. We are good to go. So that's how we can be in a position to highlight to management that given a scenario that we have produced 80 units, we can't be in a position to have the revenue that is going to cover our fixed cost and the variable cost. So we then need to be in a position to come up with the production that is going to cover our fixed costs and the variable costs. We then need to say to management, our capacity utilization is at 30%, which is 80 units. We then need to increase our capacity utilization to, say, 45%. Maybe that will be the capacity utilization to give us 120 units. That's when you can be in a position to say, we are able to make some profits. And in terms of industry, this manufacturing entity, it produces a 30% capacity. So a scenario they might be producing below the break-even point. So in those instances, they are making some losses. But it doesn't necessarily mean that they need to make the decision to shut down the entity, because initial production, a scenario muchitanga munogona kuita malosses zvenyu. Malosses anogona kukonzerwa nenyaya yekuti hamusati masvika palevel yekuti mukavhe fixed costs. But as you continue with the production, you then be in a position to come up to the level yamunozokwanisa kusvika kunge muchizokavha the fixed costs. So that's the essence of the profit volume analysis. Not yes, but in the near future, if we produce my units at Rwanda than a producer right now 80 units, we then be in a position to make some profits. So you, as the cost and management accountant, you need to highlight to the managers that these are the decisions which we might be in a position to make. We don't need to necessarily shut down the plant, but in the near future, even the indication of our production, you can be in a position to make some profits in the near future. The other aspect, profits. You can be in a position to look on your fixed costs. Those fixed costs, you can be in a position to lower them by, let's say, the machinery. Though you can be in a position to highlight to the management that if we can be in a position to purchase the fixed cost, that the new machinery that is efficient, we can be in a position to lessen the fixed costs. You see now. Thus, those are the advices you will be giving to the managers, that we can be in a position to go this way. The other aspect where you can be in a position to lower the fixed costs, you can recommend to management that this supervision, my supervisors are pushing some production unit. They are not well trained to be in a position to have efficient production. So you can be in a position to second those supervisors maybe to the country where you acquired the machinery, so that they can be in a position to get knowledgeable information to be in a position to operate that machinery. So those are the indicators you can be in a position to present the management in order to lower the production costs, so that you can be in a position to go up and above the break-even point. Do we understand what I'm trying to illustrate? Are we on the same page? Hello? Trish, are we on the same page? How about Michael? Michael, are we on the same page? Welcome, Michael. I need your response, Michael. Okay, as I'm waiting for the response from Michael, we can proceed. So we then need to look at the formula of how we can be in a position to calculate now the calculation of CV analysis. So you can actually see that in order to come up with our revenue, we would have got the units which we would have sold at the price per unit. That can be in a position to give us our total revenue. So in having that total revenue now, we can be in a position to equalize our formula now that the number of units sold multiplied by the variable cost per unit, you can be then be in a position to come up with the total variable costs. If you say the number of costs sold multiplied by the variable cost per unit, that's when we can be in a position to come up with our total variable costs. When we then add our fixed costs to total variable costs, we then come up with our total costs. If we can be in a position to add on profit now, that's when we can equalize our equation now, that total revenue equals to total variable costs plus total fixed cost plus the profit. So if we can be in a position to interchange this formula now, to play around with this formula, you can be in a position to derive your profit, you can be in a position to derive your fixed costs. Are we clear on that? Are we clear on that? For instance, if we say total revenue minus total variable cost plus fixed cost, you can be in a position to come up with your profit or loss. As I highlighted earlier on, if you add total variable costs and the total fixed costs, if they are higher than your total revenue, definitely you would have made some losses. But if they are lower than your revenue, you would have realized the profits. Are we clear on that? If we are going to make some interchanges on that, in order to play around with the formula of the CV profit analysis. Are we clear on that? Are we clear on that? That's great. I can get your comments. Thank you very much. Thank you very much. So I want to give you a scenario. I want to give you a scenario where you can be in a position to calculate now. A scenario where you are going to calculate. We've got some examples. So those are the scenarios which you are going to look at. It doesn't necessarily mean that I'm going to give you something that is going to blow up your mind. If we can go on bullet number 3.3.4, bullet number 3.3.4, there is an example there, 3.3.4, are we on the same page? Bullet number 3.3.4. I need your responses before we proceed. Bullet number 3.3.4. Bullet number 3.3.4. All of us, are we on bullet number 3.3.4? May you indicate by raising your hand? Yes, I can get it. Thank you. Thank you. So on this one now, we now need to look . So our example number 1, it says, Zesa Enterprises wishes to make an annual profit of 100,000 from the sale of appliances. Details of manufacturing and annual capacity are as follows. We have got the production in units, which is 10,000 units, and we've got fixed costs, which are 30,000, and the variable cost per unit, which is $30. Based on the above information, let's now plug the numbers in the CV equation. So we have seen that our CV equation, we are saying total revenue equals to variable cost plus fixed cost plus our profit. That's how we can balance the equation for the CV cost volume profit and equation. So if we plug on now, the figures, we've got the production capacity 110,000 units. We've got the fixed cost 30,000 units, $30,000, and the variable cost per unit, which is $30. We then need to know, in order to calculate the break-even point. Are we still remembering the formula for calculating the break-even point? We said earlier on, it is fixed cost divided by the contribution per unit. We don't need to forget that, isn't it? Our break-even point, if we are calculating the break-even point by the margin, contribution margin method, we are saying fixed cost over contribution per unit. The contribution per unit, we say selling price minus variable cost per unit. That's when we can be in a position to get our contribution per unit. Are we on the same page on that? So basically, if we are having 110,000 units, so our missing element, it is the price. If we say 10,000 units multiplied by the price, we will then be in a position to get the total revenue, isn't it? But in order to get that total revenue now, we have got, oh, sorry, I've got an interruption for internet. There is an internet interruption. I'll come back to you soon. Okay, I had lost connection. Can you see me now? I had lost connection. Are we in class now? Ah, that's great. That's great. So we can proceed with our illustration. So you can actually see that our missing link, it is the price. So basically what I've been explaining earlier on, our formula for calculating the cost profit volume analysis, it is the revenue that is going to be equated by the total variable cost plus total fixed cost plus the profit. So we are highlighted that we've got the profit of 100,000, we've got the fixed cost of 30,000. So in order to get our variable cost now, we then say the variable cost per unit, which is $30, multiplied by the number of units. That's when we can be in a position to come up with the total variable cost. So when we get the total variable cost and the total fixed cost and the total profits, we then be in a position to arrive at 430,000 as our total on that side. And we still have got the 10,000 units, but we don't know our price, which is P. If we can be in a position to move the 10,000 to divide the 430,000 by 10,000, we will then be in a position to come up with our total, our price per unit, which is $43. Are we together on this formula? Are we together on this formula? Anyone who has got a challenge on this before we proceed? Anyone who has got a challenge before we proceed? Anyone who has got a challenge before we proceed? Anyone who has got a challenge before we proceed? I would love a scenario where you can be in a position to use your microphone so that we can be in a position to be well acquainted with this phenomenon. You are not using your microphones, you are just using the charts. Michael, are we on the same page? Michael, try to use the microphone. Are we on the same page? How about pride?
I think the Chirkutir.
Hello, pride. Come again, Michael. I did not get you. Michael, come again. I did not get you. So anyone with a challenge on what we have just illustrated? Anyone with a challenge on what we have just illustrated? So we've come up with our price per unit. We've come up with our price per unit, which is $43. Which is $43. So that the price per unit comes out to $43, which implies that ZESA enterprises will have to price the product at $43 and need to sell 10,000 units to achieve its targeted profit of 100,000. You can see now. Further, we can see that the fixed costs remain constant, as I've been earlier on saying. The fixed costs, they do not change in line with the volume of production, isn't it? And then the 30,000 irrespective of the level of sales. So if you can see earlier on our graph, you can actually see that the fixed cost, despite the fact that you have produced the lesser products, you still have to pay the fixed sum of rental per month. Despite the fact that you have produced more units, you still have to pay the same. Oh, there's a connection unstable. That's fine. We are still in class. Thank you. So basically what I've been saying, despite the fact that you have changed the level of production, you still have to pay the same fixed costs. But when you have different levels of production now, your variable cost, it changes as in line with the level of production. When you produce less, you are going to incur less variable cost. But when you produce more, you will then be in a position to have a more variable cost. So that's the difference now between variable costs and the fixed costs. The fixed costs, they do not change in line with the level of activity, but the variable costs, they change in line with the level of activity. Did we understand on that? Are we clear on that? So you can actually see that if Zesa Enterprises would want to come up with the profit of 100,000, they have to charge their product at a selling price of $43. You see now. How about if Zesa Enterprise want to have a profit of 200,000? Can you be in a percent work that now? Will you be in a percent to work that if they want to have a target profit of 200,000, how much are they going to charge? You simply go and make a substitution on that formula. Can you make substitution on that formula and then come up with your trialed answer? Can you come up with the formula? You can use your WhatsApp group to be in a position to come up with those formula answers and then give it to me. You can use your WhatsApp platform in order to have the group. It is 86. It is 86. How did you come up with the 86, Lennon? You can be in a position to illustrate to other colleagues. You are quite right, it is 86, but I then need to get how you came up with that answer. $86, that's the selling price. Can you tell others you can be in a position to use your microphone?
Okay, I'm not quite well vexed enough for what is being able to understand, but I think I'm getting the concept. We are saying we have the Zesa Enterprise producer profit 200,000.
Yes.
So this is how I did it. All right, our 100,000. So yes. We have okay. Zandaita kana ngono substitute the 100,000 at 200,000 per formula multiplied.
Yes.
That's what I actually did. So the extra exactly. So pana per 100,000 our targeted profit that is 200,000.
Yes.
Times profit which is equal to that's 10,000 definitely.
Yes.
10,000 times 30
yes.
plus 30,000 plus 100,000. So now I'm going to substitution the way you did it to make the price per unit subject of formula, and then I come up with the $86.
Thank you very much, Lennon. So basically, what we wanted, Lennon explained, Lennon, and basically, we could just go on our, okay, Trish, what you are saying, I will try to assist you, Trish. Could you go on our formula on our bullet point 3.3, which is indicating our calculations? Are you there, Trish? Which is indicating our calculations? Hello, Trish?
Yes, that's where I am.
Okay, so we are saying that 10,000 multiplied by P, isn't it? Equals to 10,000 multiplied by 30 plus 30,000 plus 100,000, isn't it? Are we together, Trish?
Yes, sir.
Yes, so basically, if you just take it as it is, You just need to change the price you just need to change the profit figure. It will then be in a position to come up with the if we change the profit figure for 100,000, if we come up with 200,000, we'll then be in a position to come up with 530, isn't it? Our total amount, isn't it? We then say 530 divided by 10,000. 530 divided by 10,000, what do we get?
53.
53. So, Lennon, how did you come up with the 86? Because simply we are saying our anticipated profit, it is 200,000, isn't it? So we say 200,000 profit plus 30,000 fixed costs plus 300,000 our variable costs. So if we come up with 530,000, which is the amount which is going to equalize with 10,000 units, 10,000 units multiplied by P. So basically we are saying in order to remain with the P, we then need to say 10,000 divided by 530. So if we say 530 divided by 10,000, how much do we get? How much do we get? I want to have a correction on Lennon. It is $53. So are we clear on how we can be in a position to play around with these figures now? $53, isn't it? So Trish is right. It is $53, and Lennon has realized that it is $53, not just to double the 43 to come out with $86. So you see how we can be in a position to calculate, given our basic formula for calculating the profit volume analysis. Our left to our left, we have units multiplied by the price. That will be in a position to equalize with the total variable cost plus total fixed cost plus the profit. Are we together? Are we all together? Are we all together? Can you indicate by showing your hand, or you can be in a position to have a chat? Thanks very much, Trish. I can see your comment. Thanks very much. So we can be in a position to proceed. We can proceed to another example. So if I can give you a scenario where you can be in a position to, if you have the price, if you have the total variable cost, if you have the total fixed cost and the total profit, can you be in a position to come up with the units? Will you be in a position to come up with the units? So in line with our illustration, can we be in a position to play around with figures as well? On a price, could you put $53, the price? Price $53. We then need to find the number of units. The number of units just indicated by P. So you say P multiplied by 53 equals to P multiplied by 53. So that will be in a position to indicate our total revenue equals to 40,000, which is our variable cost. 40,000 our variable cost, plus 30,000 our fixed cost, plus 150,000, which will be our profit. 40,000 plus our fixed cost, we said 30,000, isn't it? Plus 150,000. what do we get as our anticipated units in order to come up with the profit figure of 150,000? How many units are we going to produce if we sell at $53, having the total variable cost of 40,000 and our total fixed cost it is 30,000 and our profit is 150,000? Could you be in a position to work for me the number of units which we need to produce in order to come up with a profit of 150,000? You can work in your group on WhatsApp. You can work in your group on WhatsApp. We said the total variable cost it is 40,000. The fixed cost they remain 30,000, and our profit it is going to be 150,000. We then need to come up with the number of units which we need to produce as we are selling at $53 in order to come up with our profit of 150,000. Can you give me the answer? Are we clear on that? It's a matter of substituting. It is a matter of substituting. How many units are we going to produce? How many units are we going to produce? How many units are we going to produce? Are we clear on our calculations? Thank you very much, Trish, you got it right. It is 4,150 units. If we just round down, it is 4,150 units. Or if you just want to round up, it will be 4,151. You will still get the answer correct. I will get you 4,150 units for the 4,151 in order to come up with our revenue for 150,000. Are we clear, all of us? Others, would you be in a position to present our answer? I can just see the solution for Trish. Others, could you be in a position to come up with your solutions? Others, can you be in a position to come up with your solutions? I want to get the solutions from others. Can I have the solutions from others? Right, can I have your solution? Are you getting the same answer, right? Nyasha, thank you very much, Nyasha. I can get your solution. How about Michael? Michael in Lebanon, can I have your solutions? Are we getting the same answer? Okay, that's fine. So our answer, it is 4,150. If you want to round it up, you can be in a position to get 4,151 units. So those are the units which we can be in a position to produce in order to realize a profit of 150,000 when we are selling our products at $53. So are you now comfortable now in interchanging the figures so that you can be in a position to present to management that in order to come up with our revenue for 150,000, which you have targeted in this budget period, we need to sell our products at $53, given a scenario of a production capacity of 150,000, despite the fact that we are still having the fixed cost of 30,000. Our factory rental, it is still 30,000, but we can be in a position to sell at $53 in order to come up with the profit of $153. So you can actually see that the product, the quantity, we have reduced the quantity from 10,000 as we will be selling at 43. We can reduce the quantity of production to 4,150, and then we can be in a position to change our price from 43 to 53, and we still have to enjoy the profit which is above 100,000. But then in order to advise the management that you need to sell at $53, having those summations, you then need to have an indicator in your market that your product is elastic or inelastic in order to sell at 53. If a product is elastic, you can see that if you move your price from $43 to $53, you are going to face resistance from the clients. They might not be in a position to buy your products because they are a change in price can be in a position to trigger a lower demand. If we have those scenarios, we say a product is elastic. But if your product is inelastic, a change from $43 to $53, you might be in a position to enjoy the same market share. You can actually say our product is elastic because it is not responding, the demand is not responding to a change in price. So if your product is inelastic, you can be in a position to advise the management that we can change the price and we can be in a position to produce less products and change our price from $43 to 53, and then there is an upsurge. Sorry for that. Sorry for that. Are you getting me now? We have lost one of our students, maybe of the connectivity. Can you confirm connectivity right now? I can see you. Can you confirm connectivity? Are we still in class? Everyone, can you confirm connectivity?
Yes, we are still in class.
That's great. That's great. So basically what I've been saying, if your product is elastic, you cannot afford to change your price from 43 to 53 in order to enjoy the production capacity of 4,150. But if your product is inelastic, it doesn't necessarily mean that your demand is going to change despite the fact that you have moved from 43 to 53. So you can be in a position to advise the management that we can have the leverage of moving from 43 to 53 and be in a position to come up with the units of 4,150, and we can be in a position to enjoy a higher profit margin from 100,000 to 150,000. So the hinging factor now, we then need to be in a position to get advice from the marketers that what is the response from the market if we can be in a position to change the price. If there is an adverse response, being given the fact that when you change your price, there is a change in demand. Definitely you don't need to do that. But you then need to advise the management the other aspects now. Are we going to be in a position to change the variable costs, to lower the variable costs? How do you lower the variable costs? You can be in a position to buy you can buy at lower cost. How then can you be in a position to buy at lower cost? You can be in a position to have bargains. You can be in a position to buy bulk quantities. If you buy bulk now, you can be in a position to enjoy economies of scale. That's how you can be in a position to reduce the variable cost. But the fixed costs, they remain the same. You cannot be in a position to play around with the fixed costs because they do not change with the level of production. So the aspects which you need to look at: one, you need to change your level of production. Two, you can be in a position to lower the variable cost. That's when you can be in a position to have an impact to your profit. But given the scenario which I've highlighted earlier on, if your product is inelastic, you can be in a position to enjoy by changing the price. So the three elements you can be in a position to play around with in order to change your price and your profit. You are changing the production capacity, you are lowering the variable cost, or you are changing the price. Those are the three parameters only you can be in a position to change. You can't change the fixed costs. Understand on that aspect. Understand on that aspect. So we are now comfortable in calculating the profit volume, profit analysis formula, in interchanging the values, be it variable cost, be it our profit, be it our unit. Those are the parameters which we can be in a position to change, or the price. You can be in a position to change the price. And as I highlighted earlier on, the price, you can only change the price when you have get the indication from our marketers that our product is inelastic or elastic. Are we clear on that? Are we clear on that? So if we are clear, we can then move on to our next example. We can then move on to our next example. We've got this second example. If we, example number 2, are we on example number 2? Example number 2. Thanks, Lennon. I can get your comments. I can get your comment. Others, are we on example number 2? Can you just confirm so that we can proceed? Thank you, Trish. I can get your response. How about others? You can use the chat or the microphone. You can just unmute. Thank you, Nyasha. So we can be in a position to proceed. We are good to go. Petrol Sales Limited has entered into the business of making electrical fans. The management of the company interested in knowing the break-even point at which there will be no profit or loss. Below are the details pertaining to the costs incurred. We have got the sales revenue of the company, that is at $300 per fan. So each fan is selling at $300. So we've got the total revenue of $300,000, and the variable cost, it is $240,000, and the fixed costs are $60,000, and the maximum capacity, it is 14,000 units. So in order to come up with our break-even point, we have said earlier on, our break-even point, it is fixed costs over contribution per unit. The contribution per unit, we get it by the selling price per unit minus the variable cost per unit. That's when we can be in a position to get the contribution per unit. When you get that now, we then need to divide the contribution per unit into the fixed cost in order to get our break-even point. So we are given the total variable cost, we are given the total fixed cost, we are given the total revenue. So we then need to come up with our break-even point now. So the number of units sold by petrol sim, the number of units sold, we get it by the $300 per unit divided by the total revenue. We then get 1,000 units, which is being illustrated. And then the variable cost per unit now, we say 240,000 divided by the number of units sold. We then come up with the 240. The contribution per unit now, we are saying the selling price minus the variable cost per unit. That will give us 300 minus 240. That will give us $60 per unit. Are we clear on that? Everyone is clear on that? We are saying in order to get the contribution per unit in line with our formula, we have to say the selling price per unit minus the variable cost per unit. Are we clear on that? Can I get your indications before we proceed? How we got the $60 per unit? Are we clear on that? Are we clear on that? Thank you, Nyasha. Thank you, Trish. So if we say now, we have got the 60,000, which is our...
Can you kindly go back to the previous
divide
page?
by the 60, which has been derived by subtracting the selling, the variable cost from the selling price, we then get 10,000 units. So that's Petrol Sales Limited. They need to sell 10,000 units of electric fans to break even at the current cost structure. So at 10,000 units now, they are not making profits, they are not making losses. So these are the units that they need to make in order to break even. So if they are going to sell, they are going to produce 10,050 units, they are obviously going to make some profits because the revenue would have been enhanced by the number of units. But if they are going to sell 9,500, they obviously they are not going to cover the total cost because the total cost, which is represented by the fixed cost and the variable cost, they won't be in a position to realize the revenue that is going to cover the total cost. So can you see now the essence of the break-even point? The essence of the break-even point, you need to see where your revenue will be in a position to cover your costs. Thereafter, you can be in a position to determine how many units you can be in a position to. Hello, I can see people raising hands. How can I assist? Trish is raising hands. Can I get your attention, Trish? How can I assist you, Trish?
Yes, sir. I'm wondering if we divide 60 into 60,000, aren't we supposed to get 1,000 units there?
60 into 60,000. Let me check, Trish. 60 into 60,000. Yeah, you are quite right, Trish. So there was a computational error. Thank you for that, Trish, for that observation. So we need to produce 1,000 units, not 10,000 units. Thank you for that, Trish. Others, have you seen that computational error? Have you seen that computational error? Others, are you clear on that? The correction which has been realized, what has been highlighted by Trish? Lennon, I need your attention. Where are you lost, Lennon? Hello, Lennon? From the beginning of the calculation, okay. So basically what we are saying, Lennon, is we have got total revenue of 300,000. If we say 300,000 divided by 300 per firm, we then be in a percent to come up with the number of units that are going to be sold, which is 1,000, isn't it? So when we get those 1,000 units now, our variable cost now, we've got the total variable cost. So if we say 1,000 units that have been derived by the total revenue of 300,000, which is selling at $300, we then get 1,000 units. So in order to come up with the variable cost per unit, we then say 1,000 units which have been sold divided by the total variable costs, that will be 240,000. We come up with $240. Are we clear on that? So when we get now the $240, our formula for coming up with the contribution per unit, it is $300 minus 240. That's how we can come up with the $60. When you get the $60 now, you then be in a position to divide the fixed cost by the contribution per unit, because it is from our earlier formula for calculating the break-even. It is fixed costs divided by the contribution per unit. That's how we come up with the break-even point. Are we clear on that? Are we clear? Thank you, Lennon. So anyone who has got a question before we close our session? It is 3 o'clock. Anyone who has got a question before we close our session? It is 3 o'clock. So next time we are going to wind up our chapter for cost volume profit analysis and then proceed to another chapter. Anyone with a question before we close our session?
Será que me pode share the slide Ramuna on WhatsApp group? If it's
That's
possible.
fine, Bright, I can do that. Anyone who has got a question? Anyone who has got a question? So thank you very much, class, for attending, and we had a good number of people who attended. Our participants, it was 7 people. So thank you very much. We'll see each other in the next lecture. Thank you. Good weekend.